Good morning, ladies and gentlemen. After FOMC carnage, the market was up nearly 1.2% on the day and then crash landed down 1.7% on the S&P, 1.36% on the NASDAQ. Jerome Powell came out and he finally gave us an answer to the question of will he blink? And the thorough answer is no. He said, I'm not blinking. I'm not giving you any gotcha questions. This is what we're talking about today. We're going to be giving you the key levels for the stock market that you can use today to trade and to pay attention to, see how they interact. And I do believe we are in for a bounce. So without further ado, let's dive into the video. So, in order to not repeat history, we have to understand what happened today. So the S&P 500 closed down 1.7%. We had a nice push up above our 50 daily moving average, which prior to the FOMC meeting, we looked like we were going to close above it. On the FOMC announcement, we basically got a nice push up, kind of consolidated. And then when Powell started talking, we got an even higher push up. The market ran up almost 1.2% on the day. NASDAQ was almost up like 1.5% on the day. So we'll dive into that next. But we failed to hold it. We actually failed to hold 2 days of that moving average, which is bearish. However, I am talking and calling for a bounce. Why is that? So if we dive into the volume profile, we basically see that we closed significantly below value area low. So whenever the market closes below this level, there is a high probability within the next 24 to 48 hours that we're going to retest this level at the bare minimum. We can leave this naked POC up here at 398.51 on the S&P 500. And along with, I do believe this 397 level is a high probability target. At the time of recording this video, futures are green. If we draw a 50% retracement of the Fibonacci, we see 397.28 is the 50% retracement of this move. And then if we move it to this leg lower here, we could be setting up for 395.97. So two high probability targets, this previous POC here or value area low. I'm going to be aiming for value area low, but front running it a little bit to catch a short position. I did say we were getting a bounce. I never said that it's going to continue. I don't believe that we're going to have continuation of this bounce. I do think we maybe set up an A to B leg after completing this one, set up another one, and we may see we have a possible A to B, B to C leg, which completed around the 393.05 level. So basically that's completed. Now I would like to see another one set up. So if we get theoretically that bounce, A to B, A to B, B to C, that projects the S&P 500 down to the 389 level, sub 390. So that's a definitely high probability target, and coming down towards the 386 level where we have a naked POC sitting that we haven't retested since the last push off. With that being said, we also have to take a look at the NASDAQ quickly. It has maybe a more aggressive target up into this 310 level. I think once you start getting to the 309 level, you start seeing price a depreciation at that point and maybe looking to go short then. But if we get up to that 310.61 level, then I definitely be looking to take out a short position there. I'm going to basically be dollar cost averaging into credit spreads with 2-week, 3-week, and 4-week expirations. My shopping list is basically going to be the top 5 tech companies: NVIDIA, AMD, Google, Microsoft, Apple, Amazon, S&P, and QQQ, obviously. With that, where do we see the market going from here? Well, let's dive back to the S&P 500 real quick. So we did basically close back above our 50 weekly moving average. We have not broken that yet. I do suspect if we gap up on open tomorrow, then I definitely could see a gap up, come back down, fill the gap, and keep going day. That would be the most probable situation for the bears out there. Even if we gap up, come up to the POC level, then I'd be looking to go short because it's just the momentum is to the downside. We'll be going over what's going to probably keep driving that momentum and some key things that we have to be on the lookout for. So simple as this. What are your targets for going short? Well, simply 392.82 is your 50 weekly moving average. That would probably where I start trimming on position. Next, the 200 daily moving average, the 389.22, which was around where that naked POC was coming in at 386. So we may get a pierce down to that level and possibly reverse. So definitely be trimming at the 200 daily moving average and possibly then 386 depending on how market's doing. Once we head lower, there's not a lot of price action once we break that 200 daily moving average. I'm definitely going to be aggressively adding to my position if we start breaking this 200 daily moving average for longer dated out term short positions. And if we zoom out on the daily, what does this start looking like? Well, left shoulder, head, right shoulder. So we start carving out that right shoulder possibly, and now are going lower. So next, what comes after head and shoulders, knees and toes. So definitely something to be on the lookout for. I do think the lows of the October low are going to be tested. Once we break this 200 daily moving average, then basically it's like Mike Wilson said from Morgan Stanley, that you sell every rip. You rip up, you have a nice green day, you sell credit spreads, you short the market. You basically take every advantage to short the bullishness. I think the stage is set for that. We're coming back down to this 200 weekly moving average and possibly taking out the October lows. Next, if we take a look to see if we have any A to B possible setups, this could be one massive A to B pattern that completes 390, 364, 97 right at that 200 weekly moving average. It's going to take time to get down here. So this will be confirmed once we take out the recent lows of 397.30. But once this confirms, we're taking out this consolidation period here and max pain will be achieved for the bulls. And let's jump over to NASDAQ real quick. So NASDAQ's a little more complicated story. I do think tech has more room to sell off just because how strong it was. And now that we're heading into a higher interest rate environment where the Fed basically said higher for longer, that's their terminal rate. They said 5.6 from 5.4 for the year. So therefore, we have to pay attention to that, and we'll dive into that in the video shortly. Timestamp down below if you want to skip to that portion. So my analysis on the NASDAQ is basically going to be as plain as simple as this. You break 305, you start looking for more downside potential. You have nothing once you basically break this 302 level all the way down to this 297 level around here, and then you start tackling these moving averages. We have to see how they interact with that, how the S&P is doing. I definitely think the S&P could drag tech down, and when people start going into the earnings season with the banks kicking it off, I could see more carnage there. Another thing everyone has to pay attention to is the VIX. So the VIX basically had a fake move down, bounced off its 50 daily moving average, hammer candle on the daily, and we could possibly get a reversal pattern here where things start to break. And another thing that we have to pay attention to is FRC. FRC, which is one of the big regional banks that is in trouble right now, basically has a very, very bad problem. And some of the statements that were made during the press conference by Yellen and Powell, we'll dive into that shortly, that this stock could be making new lows. Second you break that, I'm going to say $10 level, this thing's just going to waterfall down and create carnage in the market. So do you really want to be a bull in the market where your whole entire market is dependent, and I mean dependent, on this bank not failing, causing a chain reaction, causing fear in the market? And speaking of fear, let's dive into the fear and greed index. So if we look at the fear and greed index, we're right now in fear at 37. The previous close was 38. I do believe this tipped right into neutral territory during the day. However, I wasn't paying attention to it all day long. It would not surprise me, especially with the bullish reaction in the market. Now, since we're here, and since we have a long way to go to the bottom, we have a nice way to go till we hit extreme fear. If we look at stock price strength, that's really pushing this market up. You have stock price breadth. Yeah, we're near the October lows, and you're this high, guys. The market can basically crush you here. Extreme greed on the put to call ratio, and then we're heading into extreme fear and safe haven demand and junk bond. I really don't use this index as too much of a guide, and it's more of a reality check for me. We picked back up to neutral. Okay, we were in extreme fear, back to neutral. Now we're heading back to extreme fear. So I do expect a leg down. However, I would not be surprised if we come back into neutral tomorrow with the open if the S&P pushes up higher. Next, let's dive into the market events that could possibly save us from a downturn during the week. And it's pretty simple. We got building permits tomorrow on Thursday, continuous jobless claims. This has been a big market mover, but and initial jobless claims. So definitely something to pay attention to. They're expecting 197, so an uptick slightly in jobless claims, but from that 192 number, I think that could come in line, but not really give the market a lot of hope. And then we have Bullard speaking on Friday, right as when market opens, so we've got to be on the lookout for that. Remember, he's not a voting member, so his opinion really doesn't matter, but he can give you insights to what was said during the FOMC meeting. You have manufacturing PMI coming shortly after market open on Friday, along with services PMI, so we're definitely going to be on the lookout for this. Now let's dive into what was said during the FOMC meeting, some of the highlights, and just give you an overall breadth of the meeting. So Fed Powell mentioned that our lending programs are effectively meeting bank needs. So he's basically trying to quell fears in the market. Another statement from Fed Powell: inflation remains too high, the labor market is still too tight. So these two things, they've been reiterating this till they're blue in the face. Next, policymakers are generally expecting subdued growth to continue. So the Fed, through their summary of economic projections that we'll get to in a minute, guys, basically is saying that they expect lower growth. They don't expect the economy to expand, and they're hiking into those rates anyway, showing you that they are terrified of inflation. Next, you got higher rates and slower growth are weighing on businesses. So yeah, they're basically saying this is good. They're using this as a good point because they want to create demand destruction. Next, wage growth has shown some signs of easing. This was pretty notable as well. The strength of recent inflation readings show pressure continue to run high. So he's basically kind of going into the job is not done. This was also a key sticking point that everyone's pointed to as the Fed pivot, that the balance sheet had increased. Well, they had to inject liquidity, so they had to buy something to inject that cash liquidity, obviously. But we have Powell reaffirming we are continuing process of significantly reducing our balance sheet, so basically saying that blip there is not a big deal because they're going to continue selling off the balance sheet. During the meeting, he also referenced that the recent bank events are almost like a rate hike, where he said that they're going to create tightening of financial conditions, which has the same effect as a rate hike, but we still have longer to go. Again, reiterating, we will make meeting by meeting decisions based on the totality of the data. So they're reiterating they're going to be data driven. Now, for all those that are saying that we have a pivot or rate pause, they did consider a pause, but the hike was supported by stronger consensus. So they definitely had some members that were talking for a pause. You have the doves on the voting members. However, the consensus, which is the majority, voted to hike rates. One of the most notable statements that he gave is the Fed Powell, the focus on the words may and some as opposed to ongoing increases. So this was actually a response to a question of what do you mean by may have rate increases into the future? And he basically said you need to focus on may and some as his answer to that question rather than ongoing. So basically kind of pivoting to that data-driven approach rather than saying that it has to have increases. They're leaving the door open so they can go both ways. Powell, what I've observed is he likes to keep both doors open so that he can have the Hawks and the Bulls out there talking it up, and then he can pull back on either string to kind of give you a centerline consensus. So he doesn't really want to move the market purposely. Market's obviously going to have a reaction to what he said, and in my opinion, the market basically had an overzealous assumption, so there's no way he could have came out and gave you what you wanted to not move the market, and as a result, you had what you had in the market. Now, this was actually very interesting to me. He said rate hikes are well telegraphed. Many banks are able to handle this. Basically saying, guys, you know what the expectation is. Suck it up. We don't care about your banks. And even with this statement, the market sold off. Yes, disinflation is absolutely occurring. I would not be surprised if the bulls run with this tomorrow, giving me a better opportunity to short the market. But overall, I'm definitely going to be looking short-sided in the market. He also mentioned that there's a lot about this banking crisis that is going to tighten credit, and they're going to be hyper focused on the tightening of credit rather than the inflation numbers. He's going to be using the tightening credit conditions as their new metric, which for all those out there, I have no idea how you measure that because there isn't an indicator that just says here's the expectation of credit. It's a lot of indicators combined together, so we're really going to have to rely on what they say versus maybe the data driven piece of it. But I do think the inflation data is still going to drive that piece largely. Fed Powell said, "We don't know how significant or sustained the effects of this credit tightening will be. That said, we think it's quite real. This argues for being alert when we think of future rate hikes." So basically, walking the middle again. You guys see the trend here? And this, if not equivocally, the most powerful statement that sent the market lower. Participants don't see rate cuts this year, destroying the pivot narrative, destroying the bears' hopium, maybe finally putting a quash to it. But I really hope there's some hopium left, because I really need to sell these calls to these bulls, because you are going to get slaughtered. Stop betting on the stock market to go up. They basically said what all of this, we're not going to stop. So ask yourself this: what does the Fed have to see to stop raising rates? What catastrophe of when banks on the verge of collapsing do they have to see to get a looser monetary policy versus tightening into that? And again, rate cuts this year are not in our baseline expectations. He also reiterated recent liquidity provision has increased our balance, but the intent and impact are different. Basically saying, yeah, we had to do this, but our intent is still to keep cutting our balance sheet, reiterating that point. Driving that point home, recent liquidity provision has increased balance sheet size, is not intended to alter stance of monetary policy, basically adding on to what I just said. And then Moody's came out with the current inflation and labor market trends support baseline scenario of at least 2 additional 25 basis point rate hike increases by the Fed. If this didn't send a cold shiver down the bull's spine, I don't know what would, because you got it from the man himself. It is too early to say if the recent effects change the odds of a soft landing. It is hard to say if they helped the probability, though. And with that, guys, I would like to throw some humor. This is the future path for the bulls. You got slaughtered today, and next the Fed is coming for those who think they bought the bottom. Just got to throw a little humor into there. And continuing on, he did also reiterate after that statement, I do still think there's a path to soft landing. And one of the final comments that he made, our first test is to see if this is sustained tightening or not. Cut rates are not in our base case. So basically, they're not even considering cutting rates this year. And quickly, we're going to dive over to the summary of economic projections. So link down in the description below, guys, for the summary of economic projections that got released today. So if you look at the median term for the Fed funds rate, they're targeting 5.1%. However, I do want to pay attention to the central trend that's showing 5.1 to 5.6. This number was 5.4 previously, so they did increase this, which is a very subtle way of, we'll keep this number same and hope they don't see this number changing. They did also lower their growth frequency that they were expecting on GDP, so they're expecting a shrinkage in the economy, raising higher rates, and they're still revising their PCE targets and the core PCE targets downwards or slightly upwards. So they're being very aggressive with this. So we definitely have to be on the lookout until this summary of economic projection stops changing. You're not getting the pause, and you kind of got that tendency there for that you are not getting a pause from his press conference, especially because these numbers change. Once you saw 5.6% decrease in GDP, it just kind of gave you the writing on the wall, and then the press conference confirmed it. So with that, guys, we're going to conclude today's video. I really thank you for watching, and stay tuned for our weekend deep dive on Saturday. We highly recommend that, and videos through the week. And I will see you tomorrow on Viewer Requested Ticker Friday. So have a wonderful day, and trade smart out there.